Your credit score is one of the most important numbers when it comes to your financial well-being. We talk about it all the time on this channel. So why then are there several credit reporting models, and what should you do if your scores are differing between one credit bureau and the next? When purchasing a home or applying for any type of debt weapon, credit cards, lines of credit, business credit, your credit score is going to go a long way. It determines whether or not a lender is actually going to choose to do business with you. And to add to the stress that can come along with these processes is the fact that there are many credit reporting models out there, and that sometimes your score can actually vary between them. So what models are there? Now, in the past, banks, other lenders, companies that just wanted to make a ton of money by selling you credit scores developed their own scorecards to assess the risk of lending to a particular individual. And this was a cause for confusion because the scores varied drastically from one lender to the next and based on an individual loan officer's ability to judge risk. The Fair Isaac Corporation sought to solve this issue by introducing the first general purpose credit score in 1989, and this is now known as the FICO Score. And it filters all of your information in your credit reports in order to calculate your score. Now, FICO scores are just the beginning though, and you may have had dozens of other types of credit scores that you've either purchased or were sent to you, or that your credit card issuers are providing, or that you didn't even know existed. And other than the main scoring model that you'll experience beyond FICO is the Vantage credit score. The Vantage score is built off of the three major credit bureaus, Equifax, Experian, and TransUnion. So they teamed up in early 2006 to create Vantage Score solutions. So while each of these credit reporting agencies calculates your credit scores using different models, they all focus on how responsible you are with the money that you borrow. So why are your credit scores different? There are a few reasons why you might get different credit scores from FICO and each of the three credit bureaus or reporting agencies. And here are some of the most common situations. Number one, scores from different dates. Since your scores might change at any given time, it's important to compare credit scores from the same date. Number two, scores are calculated using different scoring models. So keep in mind that there are dozens of credit scoring models out there that may calculate your scores differently, even if all the data that they're using to calculate is the same. Scores are calculated using different credit reports. That's the third reason. Some lenders report to all three major credit agencies and others report to only one or two. So this means that a credit agency may be missing information that helps or hurts your credit scores. Therefore, they can be dramatically different from one bureau to the next. So we recommend that you periodically check your credit reports for errors. It's been stated that roughly 80% of reports do contain negative and inaccurate information that can be removed, and that can be affecting your scores. You can check your TransUnion and your Equifax credit reports for free on creditkarma.com. It's always the place that we recommend people start. There is another free credit reporting agency known as Credit Sesame that might serve you well as well. Also, you can visit annualcreditreport.com. And remember, you do have the right to one free credit report from that website per year, so don't go without keeping up with that. Now, why does your FICO credit score differ from others? Like we mentioned before, FICO periodically updates its credit scoring models, so there are multiple FICO scoring versions, a lot like Microsoft or any of your operating systems update. FICO is the same thing. So the formulas begin to change. Also, formulas that cater to credit card issuers or mortgage lenders or car dealers and more, each placing importance on different factors can be the reason for this. Now, if you've had a car repossessed or you've missed any payments on auto loans, as an example, your FICO auto score may put extra weight on those factors. Note that your base FICO score will likely also account for a missed car payment, but it might weigh it differently. Though your scores may vary, they're all based on the information that's provided by the credit reporting agencies. So focusing on what's in your credit reports could help you build your credit across the board. To me, there's really no such thing as a best or worst credit score. They're just different, and different lenders may use different scores. With that said, FICO scores are used in roughly 90% of US lending decisions. So your FICO scores may or may not sway over your financial life. And the best credit score out there is really an 850 FICO. It's been stated that roughly 1 million residents of the United States have an 850 FICO score, but on the other end of the spectrum, some credit scores are meant only for educational purposes and are rarely, if ever, used by lenders when making credit decisions. So what are the credit scoring ranges? Think of your credit scores as a report card that gauges your credit worthiness. The most common scores will range from 300 points to 850. The higher the score, obviously, the better. In the case of FICO scores, if you consistently score above 800, it's like getting straight A's. The national average FICO credit score right now, a C, if you will, is roughly a 695. In conclusion, it can be difficult to keep track of all of your credit scores because there are just so many types out there and each score changes over time. So to keep up with your credit, utilize sources like Credit Karma or Credit Sesame and annualcreditreport.com. Make sure that you check your credit scores and reports on Credit Karma because doing so never hurts them. So don't hesitate to stay on top of your credit. It's considered a soft inquiry. When you are applying to have credit extended to you, that will be a hard inquiry and hurt your credit. So minimizing how often you allow other agencies, other organizations, third parties to pull hard inquiry credit pulls against you is very, very important to perfecting credit. We're very strategic about how we do that and getting access to debt weapons. Now, if debt weapons is a term that is new to you, make sure you're checking out all of the videos on this channel. We'll just show you plain as day how these tools can help accelerate almost any financial goal. Very important. If you haven't yet done so, check out some of our most popular trainings, specifically those that are an hour or longer in length. Those videos will break down for you the mathematical advantages of staying on top of your credit. So guys, with that, thank you so much for tuning into another episode here on the VIP Financial Ed channel. Make sure if you haven't done so already, press that subscribe button. Consider being a subscriber, which we call cash flowers. If you want to be a cash flower, you want to have more money left over at the end of each month, this is the place to find the banking techniques to do so. So make sure you're subscribed, you turn on the bell notifications so you're alerted anytime new videos are released on the channel. Also, we'd love to hear your input. How has credit affected your ability to go out and get access to tools that might benefit you? Things like mortgages or rental properties, things like automobile loans or equipment for your business, things like credit cards or unsecured lines of credit that you can use to build wealth. How have these credit scores affected you positively and negatively? We'd love to hear that in the comments section below. Stay tuned for the next episodes coming out shortly. Guys, thank you again so much. We'll see you on the next video. Until then, make it a great day and take care.